Hello, everyone, and welcome to our financial webcast presented by Legend Financial Advisors entitled The Election in Your Investment Portfolio. I want to thank everyone for joining us for our presentation. My name's Dan, the moderator for the webcast. Today's webcast presenter is Bill Knight, Wealth Advisor at Legend Financial Advisors. Please hold as I turn the broadcast over to Bill.
All right, thank you, Dan. And welcome, everyone. So over the course of the next 30 minutes or so, I'd like for you to walk away with a better understanding of how we manage portfolios during periods of uncertainty. And the election is a great example. And I'd also like to share a few tools that we use to help our clients make the most of these opportunities. So as you can imagine, over the course of the past several months and really this year, one of the biggest questions that we've been asked is in terms of the election itself and what the impact is from the election on how we manage portfolios and our investment decision making. And as you're aware, Election Day is just over 2 weeks away on Tuesday, November 5th. And at times, the primary season can be volatile due to the uncertainty of not knowing whether or not a Democrat or a Republican will be in office. So we're going to talk about that today, and I'm going to show you an illustration that helps illustrate some of the key points. So this is an illustration, and this is from Capital Group. And it is data over the last 90 years, and it spans over 23 election cycles. So the way to read this is it dates back since 1933 when FDR was in office, goes to present day 2023, and the way this is broken down is the blue areas are when there was a Democratic presidency, and then the red areas are when there was a Republican presidency. Now this chart itself represents the S&P 500, and it shows you the growth of $1,000 over that time frame. And you can see that for the most part, U.S. stocks and the S&P 500 itself represents 500 companies, all of which are large cap stocks in the U.S. And it shows you that over time, U.S. stocks have continued to trend upwards, regardless of whether a Republican or a Democrat has been in the White House. So that's an important consideration. And one interesting item over the past 20 years, there have only been 2 times where there have been a negative year for the election year. And those 2 instances, as you can probably imagine, one being 2000 and then the other being 2008. Now, what's interesting about those 2 different time frames is the volatility in the market wasn't necessarily specific to the election itself. Those were preceded by 2 different asset bubbles. So in the case of 2000, that was preceded and occurred during the internet bubble. And in 2008, that preceded the real estate bubble. So the general point of this illustration is to show you that historically speaking, it hasn't made too much of a difference given who's in office in terms of what the overall effect on the economy, the market, and portfolios have been. One of the other main themes that we've seen this year and has been widely talked about over the past several years has been interest rates and how interest rates affect the market. So what we've seen for this year is that, and in general, that monetary policy, what the Federal Reserve does, has a large impact on the economy and on the market. And essentially what the Federal Reserve is trying to do is either expand or contract the economy. And that is something that has influenced some of our investment decision making, especially over the past year and a half. as we've seen rates were high and they're starting to come down. That has influenced some of the different bond allocations and changes that we've made over time. And really what that means for investors is that, over time, as interest rates do come down, you're likely and you're going to have a lower return on different safer investments like certificates of deposit or money market funds and so on. We had an interest rate prior to September that was 5.5%. That was lowered by the Federal Open Market Committee by 50 basis points in September, and it is now at a range of 4.75 to 5%. And the expectation for the end of the year is for potentially another 50 basis points or 0.5% of cuts over the next two meetings for this year. Now, to help illustrate some of these items and to talk a little bit more broadly in terms of how interest rates affect the market, I wanted to show this illustration. This is also from Capital Group, and this shows data dating back since 1986, and you can see it goes through 2025. And this area here in red is actually the projected data and the forecast based on what the expectations are from the market. And broadly speaking, the economy generally tends to fade when there are rate cuts. And typically what we will see is higher unemployment over time and declining inflation. And that's generally what we've seen over the past several months is inflation continues to moderate and unemployment has continued to slightly go up, although it is still historically low. And in general, when there are interest rate cuts, like we saw in September, risk assets such as stocks and credit will perform well. Bond yields will move lower, and we have seen that over the past several months where bonds have rallied. And real assets such as gold and commodities will tend to perform well. And that's certainly something that we've seen so far this year, in particular with gold. And we'll talk a little bit more about that in the coming slides. So in general, an easing cycle like we are in the beginning of today is favorable for most asset classes. And there is one caveat, and that's why I wanted to use this slide, is one of the interesting parts about this slide. So we not only have the data back since 1986, but this illustration is showing what the federal funds target rate has been over that time frame. And then these gray bars are indicators of when there have been recessions over those time frames. Now, the interesting point to note is that over the time frames of 1989, 2001, 2007, and 2019, there were recessionary periods after rate cuts. So we can see the rate cuts here, 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 and again here, and seeing those recessions that followed. Now, every situation is unique. Every market environment is unique. So there's no certain way to tell how the next year to 18 months is going to evolve. But it does become important to make sure that portfolios are well diversified so that if we were to enter more of a volatile period, that you are well prepared. And we'll talk about some of the tools that we use for our clients' portfolios. So moving on, let's talk a little bit about what's working today and what isn't, in terms of some of the different asset classes that have really performed well this year and any of those that have underperformed. So this is an illustration, and this is data we prepared from the Bloomberg terminal. And this shows a variety of different indexes, and it shows you their performance so far for this year. And this is from the beginning of the year through October 6th. And there's basically the 0% return would be right here. Below that would be a negative return. Above that would be a positive return. And you can see that the general trend for this year has been positive returns in most asset classes. What has been leading the way is actually gold. And gold has performed favorably, especially in environments where interest rates are being cut. And so far, we've seen that this year. So gold's up, roughly 27 to 28%. It's leading the pack. From there, we have the S&P 500 that has performed quite well, over 20%, as is the NASDAQ. And then we also have positive performance from some of the emerging market indexes. And then you'll see several of the other indexes are a little bit more middle of the pack, but all positive. A lot of the bond indexes here. And then at the bottom, we see two items. One is the dollar, the US dollar, and then the other is managed futures. Now, managed futures is a trend following technique that can be favorable in a variety of different market environments where it's not necessarily dependent upon a positive or a negative market environment. They just have to be able to follow a trend accurately. And that asset class performed well since the beginning of May, June timeframe, and then they've kind of underperformed since that time period. Now, to get a little bit more granular, in terms of some of the underlying sectors. So here's another illustration that we have from the Bloomberg terminal. And this goes through the different sectors that comprise the S&P 500. So within the S&P 500, we can see all of those listed up here. The top performers so far, what we've seen is that information technology has been leading the pack. And that's something similar to what we saw last year, for example, that's had very strong performance, similar to communication services. That's kind of this navy blue color right here. And then in red, we actually have utilities. So utilities has performed quite well over that time frame and has rebounded in comparison to previous years. So in general, the trend for all of the different sectors within the S&P 500 have performed well so far this year. So what are some of the strategies for navigating any volatility that we could see and manage risk in portfolios? So this becomes important, especially since we haven't seen any downside volatility. Most of the volatility we've seen this year has been to the upside. And the question is, how do we take advantage of that scenario and really be able to properly position the portfolios so we're ready for any events that happen in the future? So one of the items that is important, and one of the items that we use to evaluate our portfolios, is from Morningstar. And this is from the Morningstar Advisor Workstation report. And it's one illustration of many that they provide to be able to give a high-level overview of how certain portions of our portfolios are constructed. Now, this example that I'm going to show you first, this is from a general portfolio. This is not something that we personally use. It's something that's a good representation of what we see most common today, whether that's with prospects or general indexes or mutual funds that are a little bit more heavily concentrated in large companies and have a higher weighting to large cap companies. And the way that this works is, so it's called an equity style box. And this is showing you the overall representation of the underlying equities in your portfolio. So if you have different mutual funds or exchange traded funds, it will look at all of the underlying holdings within those funds, and it will identify whether or not those underlying companies are in the large cap area, so large companies, you can think of Microsoft, whether or not they are mid-sized, that's represented by this row, or whether or not they are small. So we have those three different areas, large, mid, and small. And then we also have further areas in terms of whether or not those companies are growth oriented, a blend of value and growth, or value oriented. Now you can see that for this particular example, this portfolio has higher numbers in the large cap growth area. And in general, its predominant exposure is to large cap companies as a whole. So 62% of this portfolio would be in large cap stocks. Now, what is interesting about this, and we'll talk about valuations in a little bit, is that this is the area of the market that has outperformed both this year and last year, and it's becoming increasingly a larger part of most people's portfolios. Valuations are also much higher compared to historical norms. So that's something that should be reviewed when it comes to portfolios. And you can also see that using this example, the areas that are less represented are the medium-sized companies as well as small-sized companies, and a little bit less in the value area as well. So when we use this to evaluate portfolios, I'll show you an example of ultimately what we're looking for and what we're doing for some of our clients. And this would basically be a representation that has more diversification throughout this equity style box. You can see that some of the portfolios that we manage will have a little bit less exposure to large cap companies, and it's a little bit more evenly balanced, whether that is value or growth oriented or in the blend area. Now, we do have more overall exposure to large cap companies, but we do want to make sure that we have sufficient exposure to medium-sized as well as small-sized companies, and really a blend of value and growth. And here's the reason why that's important. Right now, we're facing valuations, and so the price of stocks or mutual funds and so on, valuations are much higher today for large-sized companies than compared to medium and small-sized companies. And it creates an opportunity where over time, small-sized and medium-sized companies should be able to outperform over a longer period of time, because that's where valuations are more attractive. So that's an opportunity that we see. And another item to take into consideration is that different environments will be more favorable for growth, and other environments, such as 2022, for example, will be more valuable for investments in the value category. So that's something that's important and has been beneficial for our clients. In 2022 in particular, value far outperformed growth investments, and that was a great year to have exposure in the portfolios to value-oriented investments. And this year and last year in particular, growth has outperformed. So it becomes important to at least be cognizant of how the underlying equities in your portfolio are structured, and really trying to avoid if there's any type of exposure that might make your portfolio a little bit riskier than you may think. Now, moving on, one of the opportunities that this presents, and really one of the tools that we use, is rebalancing. Now, what's important about rebalancing is it gives you the ability to take advantage of some of the positive performance that we've seen in different asset classes so far this year. So if you recall the previous slide where we reviewed the indexes and the sectors that have really performed well so far this year, those were asset classes like gold, information technology, communication services, and what we've seen for our portfolios and really the opportunities for our clients over the past couple of years are good opportunities to be able to take profits off the table when those investments excel. And so we look to rebalance opportunistically. And what that means is that instead of trying to rebalance the portfolios once per year, such as in January, we look to rebalance the underlying investments in our clients' portfolios once they exceed a certain threshold. So we set something called tolerance bands. And without getting into too much detail, what that means is that we are making sales or purchases when an investment has either done well and exceeded our target, or if it has not done well, it provides a buying opportunity. So that's something that can add a lot of value and take advantage of volatility, whether that is positive or whether that is negative. Now, what are the opportunities for growth and diversification at this point in time? And coming back to the conversation on value and what we're seeing for valuations is this is an illustration from GMO, and it's called a 7-year asset class real return forecast. And a real return means after inflation. So they are using inflation at 2.3%, and based on valuations for different asset classes, they're trying to get an annual return in terms of what is to be expected for a variety of different asset classes over the next 7 years. So this is as of August 31st of this year. On the left side, we have different asset classes for stocks. On the right, we have different asset classes for bonds. And on the left, you can see that the asset class that is expected to be the underperformer is actually U.S. large cap stocks. Now, the important part about that is, as we just saw in previous slides, most portfolios today are becoming overweight large cap stocks because their performance has done so well over the past several years. And given valuations being so high, the future expected returns are lower. So that is something that we take into consideration and why we're trying to make sure that our clients' portfolios are not overweight or have too much exposure to that area, in particular the growth area. And so that's a big opportunity that we see. So we have the asset class for U.S. small cap stocks. And then we also start to get more positive numbers once we get to the international asset classes, whether it's international small cap stocks, emerging stocks, or emerging value stocks. So those are considerations and items that we've been monitoring over the past year and a half. On the right, we have the expected returns for bonds. You can see that the numbers are relatively low, and keep in mind that this is after inflation of 2.3%, but these are general expectations and can at least help you identify and helps us identify where potential opportunities are and how we may be able to rebalance into more favorable opportunities for growth. Now, the second part of that initial question was, opportunities for growth and diversification. So how can you make sure that you are well diversified? And this is a correlation matrix. Again, it's using the Morningstar software that we have, and this is a common example. So this would not be a portfolio that we would suggest. This is a common example that we see. And the way that a correlation matrix works is it shows you over a 3-year time frame, which is from August 31st of 2021 through the same time frame of 2024, is it shows you based on these 9 investments how well correlated or whether or not they move in the same direction that these investments are to one another. The legend is down here. It shows that a high degree of correlation is dark blue. The blue-gray is moderate. Gray is none. And then we get moderately negative and highly negative in the orange colors. Now, this portfolio in particular, we see mostly dark blue. So that means even though this portfolio has 9 different mutual funds, they're all highly correlated and move in the same direction. So if we were to experience something like a recession as a result of these interest rate cuts, this portfolio would move in the same way, and you may not have as many investments to have positive returns if the market does not do well. So for this portfolio in particular, the only asset class that offers moderate diversification would be the exposure to the bond market. Now, another example and one of the sample portfolios that we have, and this is again sourced from Morningstar. It's a correlation matrix over the same time frame, and there are more investments involved, and you can see that just based on the colors that there's a lot of investments that are either moderately correlated, offer no correlation, and even some that have moderately negative correlation. And I'll highlight just a few of those assets that stand out in terms of different return profiles and really ones that can perform well in different environments, whether it's a down market or a positive market. One of those is managed futures, and that is this mostly orange column here. It's mostly negatively correlated to the different investments in this portfolio, offers a different return profile. That type of investment performed very well in 2022 and was up about 16%. Other asset classes such as gold, which is 11 here, offers little correlation to most asset classes. And this year it's performed very well, also has the ability to act as a nice hedge during down markets. So whether it's managed futures, trend following techniques, or commodities, there's a variety of different asset classes where it adds a lot of value to have a portfolio like this if you want to smooth out volatility over time. So with that, to summarize a few of the different points that we've talked about so far, one of the big impacts on the market, on the economy, on portfolios has really been falling interest rates, and they're generally positive for most asset classes. The other is to be aware of the type of equity exposure that you have in your portfolio. So for our clients, it's something that we monitor really on a daily and weekly basis, and we monitor how it changes over time for our different portfolios. And it also helps us be aware of different opportunities we may be able to take advantage of. And I think the biggest opportunity set that we've seen for prospects portfolios is really the growth in large cap stocks has been so significant over time that most people don't fully understand how much exposure they have to those areas. One of the opportunities and one of the tools you can use to take advantage of the positive performance this year and last year is really to consider rebalancing the portfolio. That's been a great opportunity for us, whether it's been rebalancing positions in gold, in technology funds such as the NASDAQ, and really other opportunities that we've seen over time. And it really gives you the ability to sell high and buy low if you do it right. And then from there, really considering diversification. Because if we were to enter a time frame, given these rate cuts, if there were a recession ahead of us, it's always pays off to have proper diversification in the portfolio, just so you have a different return profile in different types of investments that can add value and can be positive during those different market environments. So with that, I will open it up to Q&A. Feel free to ask any questions that you may have. Now, one of the questions that was submitted was a question related to the election, and the question said, there is speculation that portfolios could be taxed on unrealized gains. What, if any, are steps that need to be taken to prevent this tax, and what are the minimum thresholds that this would affect? So it's a great question, and to clarify unrealized gains versus realized gains. A realized gain is when an investment is sold during the tax year and you are responsible for paying taxes, if applicable, on the sale of that investment. Now, an unrealized gain would be if there were no sales in that investment, and what was proposed was for taxpayers with wealth above $100 million would have to report their unrealized gains and potentially be taxed on them. So that is the threshold part of the question. It's $100 million in terms of the wealth amount. And in terms of steps that would need to be taken to prevent this, that part's difficult to answer. This proposal has failed to gain congressional support and would be very challenging from an administrative perspective. So I think it would be a surprise if that did go into effect. And also it's something that would only affect just over 10,000 people. So I don't think there would be any necessary steps at this moment, given it's just something that is being talked about and doesn't have a strong base of support. Another question that was asked is, how do you know a recession is forthcoming? So it's a great question, and there's a variety of indicators that can help you identify whether or not a recession is forthcoming, and not always are they going to be accurate. One that comes to mind and that we've seen over the past year and a half is the inverted yield curve. So that's a common recession indicator that has predicted, I think, 7 of the last 8 recessions. And we've had an inverted yield curve and for the longest period of time that's been recorded without having a recession. So that's a particular indicator that we follow. That's not always accurate, and that gives an idea of what the market is thinking in terms of what is going to happen in the economy. There's other indicators, whether it's monitoring what is happening with employment, and if unemployment rises by a certain amount. Other items to look at is really what is happening in the market, because the market itself is really trying to anticipate what is going to happen over the next 6 to 9 months, and that is how it's going to move. So a variety of indicators to monitor. Those are a few that we review and keep track of in terms of making any decisions. And another question was, why has the 10-year bond yields gone higher despite the Fed rate cut? So that's a great question. And really, some of the different movement patterns are going to be a change in expectations. So anytime there's uncertainty or a change in what the initial expectation is, you'll see different movement in the market. Now, initially, we saw movement in the 10-year bond yield go down as we got closer to rate cuts, and those market expectations were fulfilled. But since we had some data that was a little bit more positive than what we initially had a few months back. And some of that positive data was based on what was happening with employment being a little bit stronger than what was initially anticipated. That changes what the market expectations are for what future rate cuts will be and the speed and amount of those rate cuts. So it's essentially data that is being released that might be better than expected or worse than expected. And if that is different from expectations, it is going to have an effect in the market. Great question. All right. It looks like those are all the questions for today. Thank you for attending today. Appreciate the questions. And for those of you, if you ever want feedback in terms of the level of risk in your portfolio, the level of diversification, or really want a better understanding of what the equity exposure or any of the exposure in your portfolio, we're always happy to help. You can reach out to a member of our team. And with that, I will turn it back over to Dan. Thanks, everyone.
Great. Thank you, Bill. A lot of good information you covered today, and I want to thank everybody for joining us for our latest presentation. If you'd like to schedule a free conference call consultation with a member of our advisory team, please call our office at 412-635-9210 to set up an appointment. Thank you again for attending, and this concludes the event.